Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, if you've clicked on this video hoping that you will get some hot stock tips, sorry to disappoint you. I'm not going to do anything of the sort. I'm not going to give you hot stock tips. In fact, I'm more of the view that if you give a man a fish, you will feed him for one day or a couple of days max. But if you teach him how to fish, you will feed him for a lifetime. And that's going to be pretty much my intention in this video, and of course in the forthcoming videos as well, to try and give you techniques and principles of investing which will help you create long-term wealth in the stock market. Of course, most of these techniques and principles are not my own. These are the techniques and principles that I have learned from the legends of investing. People like Ben Graham, Warren Buffett, Charlie Munger, Seth Klarman. So as Sir Isaac Newton says that if at all I have managed to look any further, it's because I have stood on the shoulders of giants. And the giants for me have been the gentlemen that I just mentioned. And so whatever little I've learned about investing, I've learned from these gentlemen, and I have tried to apply them to the Indian stock markets, and had a few observations which I keep sharing with you through these videos. So now let's jump to today's topic, the burning question, I think, which is on the mind of each and every investor. What is a perfect investment, or what are the perfect stocks that one should invest in, taking into account the current market scenario where the markets are going up and down? One day they are up 1,000 points, another day they're down 1,000 points. So it's quite an up and down volatile market that we are seeing. So what are the kind of stocks that one should invest in such a market environment? Let's try and understand this. Let's try and understand what makes for a perfect investment in this environment with the help of a case study. So what you're seeing on the screen right now are two companies, company A and B, and you have to choose between these two companies. You have to choose just one company to invest in. So which is the company that you will invest in? Let's try and understand. Company A, company B, when you analyze companies, you analyze them based on mainly four parameters: the stability in earnings of the companies, the quality of the company, the quality of earnings, the growth, and the financial strength. So between company A and company B, I think clearly company A seems like the better company. There is stability in earnings. There's not been a single year where the company has recorded losses. All positive. There's financial strength. The average debt to equity ratio of the company has been almost zero, which is very good. The quality of the company is quite good, as you can gauge from the average ROE that the company has generated of 15% over the last 8 to 10 years. And the most important thing is it looks like a company which is growing at a very fast rate. From an EPS of nearly 82 rupees in 2013, it has nearly more than tripled its EPS within 6 years, and has an EPS of 253 rupees in 2019. So in terms of growth, in terms of stability, in terms of financial strength, in terms of quality, it looks like a very good company. Company B, on the other hand, I would say it's slightly inferior to company A. There is no stability in earnings from the point of view of the fact that the company has recorded losses. Its EPS has been negative in 1 year, and there is no clear pattern of growth. So even the growth is missing. Has a very high debt to equity ratio of 2.3 times, and has a decent ROE which is equal to that of company A in the region of 14-15%. Now there are two kinds of investors. Investors who would not touch company B even with a 10-foot pole. They believe in investing in good quality companies, high growth companies, and they will 9 times out of 10 choose company A. Nothing wrong in this. Each investor has a certain temperament, has a certain attitude towards investing. And if he likes company A over company B, that's fine, perfectly all right. However, there's a different kind of investor which believes in the fact that every company is worth buying at a certain price and it's expensive at a certain price. So he will look at company B from the point of view of its valuations. If company B is trading at a very attractive valuations, he will not hesitate in investing in company B, provided he is confident that that loss that a company incurred in 2019 is a temporary phenomenon, and very soon it will start earning the average EPS that we have shown in this table of 34 rupees over the next 2 to 3 years. Therefore, if he is confident that the company is going to be able to reduce its debt, and that loss in 2019 is a temporary blip, he would be looking forward to invest in the company provided it's available at attractive valuations. Company A, on the other hand, it's a high growth company, and the risk that the investor would face here is it's a quality company, and it will seldom be available cheap in the market. It will always be available at attractive valuations, because just as you think that the company A is a quality company, a lot of other investors also think that the company A is a quality company, and therefore it will be priced accordingly. So for the risk that you run in terms of company A is that risk of overpaying for the kind of quality that you're getting. If you pay a very high price for company A, then that's a risk you're taking. And on the other hand, the risk in company B is that even though you're buying it at an attractive valuations, the business may not return to its original shape and form for quite some time to come. It may stay in the doldrums over the next 3 to 4 years. It may not recover. The debt equity ratio may remain high. So even though the company that you're buying at an attractive valuation, it may turn out to be a bad investment. So how should you approach this? If you are confident about company B, if you've done your research and you feel that it is going to earn an average EPS of 34 rupees going forward as well, and 2019 was an aberration, you go ahead and invest in company B provided the valuations are attractive. Company A, you should draw a line as to what is the maximum price to earnings multiple that you should give to company A. If you're not careful about that, you will end up paying a very high PE multiple to the company. And a broad thumb rule that I follow when it comes to a company like company A is not pay more than 18 to 20 times price to earnings multiple for company A. And if at all I have to invest in company B, I'll invest in the company B at a single digit, at a medium to high single digit price to earnings multiple of say around 6 to 7 times. So for company A, I will pay a price to earnings multiple of around 18 to 20 times, so that it's not very high. And company B, I'll pay a price to earnings multiple in the single digits, low to medium single digit price to earnings multiple, if I'm confident the company B is going to earn an average EPS of 34 rupees going forward as well, and it's going to bring debt under control. Now, why is this price to earnings multiple of 18 to 20 times, and why this price to earnings multiple of single digit for company B? I think it's part based on experience. Historically, if you've paid 18 to 20 times for a company like company A, you've done well over the long term. And if you've paid a single digit price to earnings multiple for a company like company B, which eventually recovers, again you have done quite well over the next 3 to 4 years. So part of it is based on experience, and part of it is logic, in the sense that for company A, you paying 18 to 20 PE means that if you inverse the price to earnings multiple, you get the earnings yield, which is in the region of 5 to 6%. So in effect, you're getting a good quality bond where the coupon is growing. The coupon in this case is the earnings of the company. So you are think of it as a good quality bond where the interest that you're getting on the bond is increasing every year. So that's your margin of safety. And in company B, since the company has a stable constant earnings, you are upfront demanding for a high earnings yield. So if you giving it a price to earnings multiple of 7 to 8 times or 6 times, it translates into a yield of 16-17%, and there's enough margin of safety there. So this is the logic behind giving us low single digit price to earnings multiple for company B and a price to earnings multiple of 18 to 20 times for company A. So let's see what was the valuation multiple these companies were trading at back in March 2020, a year ago. So company A was well within a buy limit. It was trading at a price to earnings multiple of 17 times, which I think is a good level to enter company A, as we just mentioned, as we just gave the reason. And company B was trading at a very low price to earnings multiple of 2.1 times. In effect, the investors were assuming that the company B would go bankrupt. So if you had done your homework and if you were confident the company will not go bankrupt, and in fact it will turn around, and that 2019 was just a blip or an aberration, you would have made good amount of money in company B, and company A was also available at a decent price to earnings multiple, where the chance of making good money over the next 1 to 2 years was quite high. So let's see what these companies are, company A and company B, and how they have performed over the next 1 year. So company A is Maruti Suzuki, and between March 20 and 21 it has gone up 66%, which is not a bad return at all. Look at company B from the same sector, Tata Motors, a price to earnings multiple of 2 times, and if you were confident that Tata Motors will survive as an enterprise and it will go back to earning 34 EPS that it has earned in the past, you would have been rewarded 5 times over. 100 rupees would have become 500 rupees in the case of Tata Motors, and it would have become 66 rupees in the case of Maruti Suzuki. Worth pointing out that I think Maruti Suzuki, before the crash of March 2020, was trading at a very high price to earnings multiple in the region of 35-40 times, even higher if I recollect properly. And Tata Motors also at one point in time was trading at a high price to earnings multiple 3-4 years back. So that was not a good time to invest in these stocks, because one was very both of them were valued way above the intrinsic value. But March 2020, because of the crash, Suzuki fell to a reasonable price to earnings multiple of 17 times, and Tata Motors gave those fell to a very attractive price to earnings multiple based on its normalized earnings of 2 times, and gave those kind of returns. So what is the perfect, coming back to the question, investment in these up and down markets? This two stocks, Maruti Suzuki and Tata Motors, they stand for categories of investments that you should look at when investing, not just in the current market but for all the markets, be it any market. If you're looking to invest in a quality company, a growth company like Maruti Suzuki, you should ensure that you're not paying a price to earnings multiple of more than 18 to 20 times. If you do that, if you have a portfolio of stocks which has a price to earnings multiple of between 18 to 20 times, low debt, good ROEs, good growth, then I think you'll make good money from the stock market over the medium to long term. But if you want to invest in a company like Tata Motors, where you are confident of the future, where you think that the loss that the company has earned in 1 year is just temporary and it will come back to its old form and shape, then you should buy companies like Tata Motors, but not pay more than mid to single digit multiples. So I think both investments can end up making you good money over the long term. It entirely depends on your attitude, on your temperament. What kind of investments do you prefer? If it's something like Maruti Suzuki, remember the price to earnings multiple that you need to pay for the company, and you should be confident that the company will continue to grow over the next 3 to 5 years. If you're buying a company like Tata Motors, that's also fine, but do not pay very high P multiples and have great confidence in the future of the company. If you think that the enterprise will survive over the next 3 to 5 years, only then invest in a company like Tata Motors. Otherwise it will end up being a speculation and it will lead to losses. Ditto for Maruti Suzuki. If you pay a very high price to earnings multiple, your investments can go nowhere for a lot of years. Your money will not compound at a good pace and you miss out on returns. So irrespective of what market we are in, Always try and classify investments into these two buckets and pay the appropriate pre-multiple, and have a portfolio of stocks, which either resemble Maruti Suzuki or resemble Tata Motors. And if you do not find stocks good quality stocks which are attractively valued, you stay in cash. If you do not find companies like Tata Motors which are available in a single digit price to earnings multiple of 6-7 times, again stay in cash. That's, I think, the ideal approach to take. So it's either Maruti Suzuki kind of a company or Tata Motors kind of a company. So yeah, these are the investments, perfect investments in my view, not just in the current market but across all kinds of market. So try and invest using these principles and techniques, and I'm sure that you'll not get a bad result out of your investment. So that's all from me today. I'll see you again next time. Thank you so much.